I'm Randy Wilburn, Director of Education at Zweig Group. Welcome to our online ZLearning course, How You Can Be a Better Financial Manager, Part 1, Accounting 101. This 1-hour continuing education program will help you to develop and strengthen your financial and accounting skills. You may not end up taking over for your CFO or controller, but you will be able to have a conversation with them and begin to understand what they are talking about and how it relates to the projects that you are working on or managing. This is the first of a 3-part series that you can watch on financial management for the design industry. Make sure you download and print out the notebook that comes along with this accompanied video that will help you follow along and take notes as you listen to these amazing instructors today. Our guests today are Claire Kiser, Director of Consulting at Zweig Group, and Robert McCauley, a consultant here at Zweig Group and a financial and accounting specialist and a recent CPA, not necessarily a graduate, but you just got your CPA exam passer, which is huge. So you certainly have the expertise and skill set, and Claire has a considerable amount of experience in this space. And so we're really excited to have you guys both here today to come and talk a little bit about, financial management and accounting from the project manager perspective. Certainly none of these individuals that are watching this video are going to go out and do any mergers or acquisitions, at least we don't think, but this is an opportunity for individuals to gain some additional perspective about, understanding financial, just the nomenclature, understanding accounting basics so that they can do their job better each and every day. And so we've come up with a range of simple ideas and themes to kind of help everyone make sense of the numbers, whether you're working on project utilization, trying to read a balance sheet, or just want to know what EBITDA is, which is like my favorite word in the whole financial dictionary. I certainly know I want to learn more about that, but you're definitely watching the right video if that's the case. This is the first of a 3-part series that you can watch on financial management for the design industry, and we're going to focus today on Accounting 101, how you can be a better financial manager. And really want to thank you both for coming on today. How are you guys doing?
Great.
Doing well this morning. How are you?
Good. I'm glad to be here and glad to be with you. Let's walk step by step through some simple ways that our audience of engineers and architects can develop and fine-tune their financial and accounting skills.
Well, so I think we're pretty excited. If they're like any of the architects and engineers that we know, they'll catch on pretty quick.
Absolutely. This is a smart group, so this shouldn't be that difficult. Robert and Jamie, when it comes to accounting best practices, can you walk us through some of the different methods of accounting? And you don't have to fight. You guys can just pick and choose which ones you want to jump in and talk about. But why don't you kind of let's start there with the foundations of accounting.
I'll defer to the CPA in the room to start this conversation.
Okay.
Excellent. So first we'll just go over the two main methods of accounting.
Okay.
Which are cash basis and accrual basis.
Okay.
Cash basis is more common among smaller companies, and that's where you don't recognize, or you recognize the revenue expense based on the cash you receive or the cash you pay out. And so it's very hard cash oriented. You're recognizing revenue when the cash comes in, not when accounts receivable comes in, but when the actual cash comes in, and you're not recognizing the expense until the cash is directly paid out, and not necessarily payable. Whereas the accrual basis is where you're recognizing the revenue on a kind of, you're matching the revenue expenses with the time that they happen. And so you may have a 2-year contract for $10,000 in year one, and you're going to recognize that revenue in year one.
Okay.
because you received that contract in year one. And whereas the cash basis, you would receive only the cash you received in year one, and then the cash you received in the year two, the final year of the contract in year two.
Okay.
It makes a huge difference in this industry too, especially when you consider that the average collection period is something like 76 days, I believe, this year.
Yeah.
So there's a huge difference in how you're accounting for it because there's so much time that passes between invoicing and receiving.
Right. Okay. And Jamie, Claire, why don't you, just to kind of take it a little bit further, but given all of your experience with a wide variety of firms in the design industry, with these two different methods of accounting, cash basis and accrual basis, which one is preferred or kind of a hybrid of them both being used?
Well, I would actually say a hybrid method is the most commonly one. Most firms will recognize revenue on an accrual basis, so when the invoice goes out, when it's billed, and then they'll recognize expenses on a cash basis. I would say it's called modified cash.
Modified cash basis.
Yeah.
Okay.
I think that's probably what we see the most often, and I think it makes the most sense in this industry too. You have to keep track of all of them. You have to keep track of your cash basis, or you may not make payroll. Just because you've invoiced it doesn't mean you have cash in the bank.
Right.
But if you over-focus on accrual and don't focus enough on collection, you can similarly not make payroll.
Yeah, okay.
So it's important to keep an eye on both. But I think most firms, I would say, follow a modified method for internal purposes.
Okay. All right. Well, that's cool. Robert, there are so many terms and acronyms used in accounting. What would be the best way for a novice to learn them all, or better yet, determine which ones are the most important to remember?
Yeah, Randy, I think before we kind of get into the terms and the metrics a little bit later on, it's really important to realize that just in the basic income statement, there's two parts. You've got your revenue and your expenses, and it's very easy to focus on those revenues because that's the cash, and that's what's coming into your business. But I would say it's more important to focus on what's at the bottom, the EBITDA and the operating income, which is revenues minus expenses, because if you focus too much on revenue, your expenses can be growing at the same rate, and your margin, your profit margin, your EBITDA margin is staying the same, and you're not really growing your business. You're kind of just increasing the numbers. And so you want to increase your revenue while limiting your expenses or trying to taper those off.
Okay. All right. And there's that fancy word again, EBITDA.
EBITDA. It's a
EBITDA.
Magic word, isn't it?
It is a magic word, and just for the interest of our audience, why don't we talk about EBITDA just a little bit, just so they have a better understanding, because people flout that word around, and I honestly believe
it's a fancy word.
It's a fancy word, but some people use it and they still don't know really what it means, and that's why I think it's kind of cool just to break it down. And on the video, what we'll do is we'll kind of give some images to show and really elaborate on what you are describing, but just so the audience has a better understanding. Why don't you kind of break it down in its I know it stands for different things. So
yeah, and so to get to EBITDA, let's just first get to operating income. You're going to do revenues minus direct labor and minus other operating expenses, general admin, and expenses to help you run your business on a day-to-day basis. So that gets you to operating income. And within those operating expenses, you'll include interest and taxes and depreciation, amortization, and that's where the EBITDA comes from. The E is earnings before interest, taxes, depreciation, amortization. Okay. And so your operating income, and you want to add back those expenses because, for one, the interest and the taxes are going to be different across regions and across different tax jurisdictions. Right. And interest is something that's not really correlated with the operation of your business. And then the depreciation and amortization is not a cash flow expense. It's an annual expense from an asset that you purchased, and it changes with the type of depreciation method you chose to use for your business. So it's not necessarily, you're not paying anything that year, it's just expensing an old asset year after year. And so it's not necessarily an expense, it's reducing a fixed asset.
Okay.
And
so this word again, just
that complicated things.
That was a complicated description of it, but that's exactly important though, because there's also a bit of a nuance to depreciation because you can make choices with it, which is why it's important to understand what those choices are, and adding it back is a good way to do that. So you could accelerate the depreciation and take a lot in 1 year, which is going to reduce your profit significantly.
Section 179 expense, which is treating it as an operating expense in the year that it's purchased.
So there's a lot of decisions you can make with it. So, you know, you said it's not a cash expense, but it kind of can be though, because there is a replacement value. So if you're a firm that has a lot of survey equipment or something, you buy something in year 1, you know you're going to have to buy another one in year 7. So you can depreciate it over whether it's 7 years or whether you can choose to depreciate it all in 1 year or 2 year. I'm not even sure what all the options are, but there is some residual expense that's going to happen again. So it's kind of in recognition of that is why you're allowed to depreciate it. Is that?
Yeah. So just let's take this whole EBITDA discussion just a little bit further down the rabbit hole, and if you could maybe just talk about how that impacts or how a project manager. I'm a project manager. I'm an engineer. I'm an architect working at a firm. I'm dealing with projects on a regular basis. I have several projects on my plate. From a financial perspective, how does EBITDA affect me? Is there something I should be concerned about with regard to this?
Well, if you look at EBITDA as it related to your specific division or your specific project team, you can really look at where your expenses are going without or excluding those expenses that you can't control, like interest, taxes, and depreciation. And so it's really removing those items that you can't, that are already have already been decided how they're going to be expensed.
Yep.
And looking at the ones that you can't control at that point in time.
Okay.
You know, that's for the same reason we also try to look at it pre-bonus if possible too, because we want to know what discretionary bonuses were paid out. You're not going to pay out bonuses in most cases unless you can.
Right.
So when we look at EBITDA, when we're trying to value a company, for example, we'll look and say, okay, you know, what are the discretionary expenses? So let's say we were super profitable on something. So we spent an inordinate amount on an awesome steak dinner to celebrate.
Right.
Would we have done that had we not had the profit?
Right.
No, but we're reducing profit by going out for this steak dinner. So it's understanding the components and isolating the discretionary pieces too. So something that we do when we look at a company is we add back the discretionary expenses like that. Say, okay, what did they do just because they could? You know, that's an important part of the process too. And I think as a project manager, just understanding what the flexibility with that margin is.
Yeah.
You know, if we are this profitable, what can we do?
Right. So steak dinners for everybody if you have a profitable project. I mean,
That's exactly what I'm advocating. Yes.
So,
Yes.
So, all right. Well, that's cool. I appreciate that, and you guys have kind of given me a fair idea of EBITDA and how to understand it. And certainly, those of you that are watching this video, you'll be able to follow along with the video notes for this particular training, and I think you'll find that helpful as well. And we will add in the definitions and that information that goes along with what Jamie, Claire, and Robert are talking about. They're the experts, so that's why we're counting on them for some additional information here as we go through this. Now, Robert, you also mentioned that it's important to get with your accountant or head financial employee for those that really want to get a better understanding of the numbers and just how things are being done within their respective organization. Can you speak specifically to that and maybe some tips that you would recommend for that average project manager just to get a better handle on things from a financial perspective?
Yeah, absolutely. And like you're doing now, you're asking questions kind of about the metrics and the basics of the income statement and balance sheet. And you know, it comes down to if you don't have knowledge about something, you got to go to the person that does have knowledge about it. And so within your company, there's going to be someone that has knowledge on the financial statements, the balance sheet, income statement of owner equity, and they're going to be able to give you kind of a nice little basis for those metrics, as well as how the metrics that their company is focusing on. And so getting with them and just being curious about the financials so that you can do your job better. I think we'll talk about open book management a little bit later.
We are.
And so that's been a helpful tip for us, I know, and is really something that's come up in the industry and has been pretty successful thus far.
So in most firms, the person that you would speak to about that, their title, so your favorite is EBITDA. My favorite title in the world is controller. I really love that title.
Okay.
I've been angling for that, but unfortunately I don't think that I'm going to get that title anytime soon. But controller is the person usually who's responsible for the historic reporting functions, managing the accounting staff. That usually falls to the controller. In most firms, that's the person you would go to start asking those questions.
All right. And just to take this one step further, and I think you brought up a really good point, because people have different roles in different organizations, financial roles. So can I give just a loose definition of a CFO in your mind?
Yeah.
Just so people can kind of, because a lot of times people equate CFO and controller in the same breath, and they are totally different.
They are totally different. Yeah, you're absolutely right. So I have, on my litany of terrible jokes, one of them is everybody in the accounting department counts.
Right.
Good.
Nope.
The controller's job is the historic reporting functions. The CFO is the financial strategy, and that's the forward-looking aspect of financial management. That's the what do we do now.
Right.
They usually manage the capital structures, the banking relationships, financing decisions, so things that will help the company grow and get to the next step, usually are CFO level.
Right.
CPAs, if you have an accountant in your firm, they're usually on the controller historic reporting side.
Okay.
That's usually the distinction there. There are other titles that lots of other firms have too.
Accounting manager. Things of that nature.
Yeah.
It just depends.
Yes.
So,
Is there?
Yeah, I heard her say bank relationships, and that brought up another point that I kind of wanted to get into, and how important it is to keep your income statement and balance sheet and statement of ownership equity up to date, whether it be a quarterly or semi-annual basis, because you never know when you're gonna need that next loan, or you're gonna have an owner leaving, or you're gonna want to add a new owner, or sell your company or buy another company, and those income statements are essential to smoothing out that process and getting a healthy and very reflective true value of your company.
Okay. All right. Cool. Now, what about just in general? You're kind of mentioning we've kind of gone over some of the main positions within a company that deal with financial issues. Any other recommendations, guides, or anything like that you would recommend for people that are just kind of throwing themselves into the field of understanding financial and accounting numbers and just themes?
I would say it's really important you can look at benchmarking data like something in our survey or other things that are out there about, the industry average. But I think what happens the most when we talk to firms is we'll present the industry average and then they'll tell us how they're doing compared to it.
Right.
And they're calculating it totally differently. Okay. So I think having a good sense of how your company does things, there's nothing wrong with it. These are just ways to tell how the company's doing. If something works better for your company, that's fine. But understand then that the metrics that you can get from somebody like us might be different. Right. So I think making sure that people understand how stuff is calculated is really, I would say, one of the most important things you can do to become more financially literate in your own organization.
Okay. Yeah, and I think a lot of what you can get out of programs and books like our financial manager books and financial performance surveys are some of those best practices from a benchmarking perspective that can kind of tell you, well, you're on the right track, or actually maybe you should do it a little differently.
Yes.
And I think it's really important to do that. And it's certainly, even with our financial performance surveys that we offer at Zweig Group, there are metrics that you can get into that really will elaborate, how you're doing and what's working and what isn't working. So certainly want to encourage you, and possibly maybe even these video tutorials will help you out along the way and give you some more things to think about. And I think that's just part of the process, is that there's a lot of information and data points out there. I think you need to glean what's important for your organization and how it incorporates into the bigger picture of what you're trying to achieve and accomplish with your company. So
I think another kind of tip for project managers is kind of periodically looking at your sources of revenue and your expense line items to see really where your revenue is coming from, because it's you can feel emotionally that you're getting your revenue from this or that or expensing these specific line items, but you really don't know factually until you look at the income statements. And so you may look at your sources of revenue and you may notice that you've got one source of revenue that's really become your main source of revenue, and that kind of adds a little bit risk, because what if something happens to that one source of revenue? You're not diversifying your revenue sources enough, and so you're kind of putting all of that revenue in one basket, which is a little bit risky. Okay. And then with your expense line items, you can go in depth, have a little line by line analysis, and really see where you're spending your company's cash. And there may be one on there that comes by surprise to you. Say, for instance, business development
Yeah.
expense could be kind of growing, but your revenue's not growing, and
Right.
so that's if you're spending this X amount on business development and business is not developing, then there could be an issue there.
And right, yeah, you know what? Yeah, exactly. That's a great point, especially if you're a company that touts itself on repeat business with clients.
Yeah.
It's like, well, then why are you investing so much in new business development?
Right.
That's not what you're trying to do. That's a great point. The other one too is return on marketing investment. I think having a good idea of who your customers are, like you said, and those revenue sources, where is the revenue coming from? I think tracking our marketing expense associated with pursuit of that revenue is a really good idea. Not just business development, I mean true marketing as well. Of who are we trying to target? What is the message we're trying to put out there? But looking at those expenses with who we are now and who we want to have on our customer base, or what employees do we want? You know, are we recruiting at the right places? Those are all generally in kind of a marketing sort of expense bucket. So having a really good deep dive into those figures and understanding what those expenses are, and in pursuit of what, you know, what are we trying to do with that investment?
Okay. All right. Cool. So, so we've talked about some of the different methods of accounting, accrual, cash. Now, isn't there also an income tax basis method of accounting?
There is an income tax basis isn't used too often internally.
Okay.
You'll see the income tax basis is exactly that. You'll see it on the income tax form, and it's very similar to the accrual, except for there are a few different line items: depreciation, meals, entertainment, and there's a few other ones I can pull out my notes. But there's
Right.
just a few different line items that are accounted for differently, and it's essentially same way that it would go on the tax return.
Okay.
And
All right.
so not something we see very often in this industry.
Yeah.
But-
Or maybe it's something that might come up when tax time comes around, and you need to recast things and look at how you spent money across the spectrum of the company. So, all right, and then you based on this information, the accrual and cash basis accounting methods. Tell me how firms recognize revenue and what financial statements go along with that recognized revenue, just for people to have an understanding of what they're looking at, you know. And so if you could talk a little bit about that, that would be great.
Yeah, and we can talk a little bit about the income statement a little bit more with the
Okay.
balance sheet. I know from some of the financials we receive, we'll see, which has been really helpful, is having revenue by client or revenue by division.
Okay.
And so with those two, you can kind of break down income statements by those specific divisions or offices.
Mm-hmm.
And so that kind of gives a specific income statement, balance sheet, maybe not balance sheet, but income statement for those specific divisions. And from there, they can work on improving their revenue and expense efficiencies or inefficiencies.
Okay.
Most companies recognize revenue by either geographic location, so office location, Fayetteville office, Atlanta office, or they will do it by discipline,
Right.
civil, survey, or they will do it by market sector, which would be like airports or municipalities. So those are probably the three most common ways that firms are organized and would report their income on those different ways. So either where their revenue is coming from geographically, the client type that's providing that revenue, or the discipline that's supporting that revenue. And I think that's why having that additional information about who the ultimate client is really important, because you could have a huge client that you're serving out of multiple locations, or ideally with those big clients you're doing work across your disciplines with them. So that's why knowing the ultimate source of who's writing the checks is much more informative, I think, than just specifically which office is performing the service or which discipline is performing it.
Okay.
You know, there's not a wrong way to do anything that we're talking about here, but I think the most forward-thinking method of all of these is market sector.
Right.
I think knowing who is buying your services is more important than where or what they're buying. I think knowing who those ultimate buyers are and figuring out patterns. Is this client type a slow payer historically? What are the trends going on in land development, and how can we better serve our land development clients? I think that's more forward-looking in terms of how you're going to organize your income statement than any other method.
Yeah, and I know at Zweig Group we tend to recommend the market sector approach. I know Mark Zweig feels very strongly about that. I know you do, and I certainly, we could go down a rabbit hole talking about that and the importance of it. So maybe we'll have to come up with another video to talk about market sector madness. I think that would be an interesting conversation. So just to kind of take this a little bit further, and so we've got income statement, balance sheet. These are some of the important documents that an individual in a design firm should at least have some semblance of an understanding of. There's so much that goes into accounting at a design firm. I know that there are some AEC industry specific accounting terms that a lot of firms use, but that not everyone knows how this information is derived. And so I was wondering, I know one specific that comes to mind that's just thrown around all the time is NSR. And I know NSX is a car that's made by Honda, or Acura rather, but I know NSR stands for net service revenue. And can you explain how you get that, exactly what NSR is and how you get that figure?
Claire, I'm gonna let you take this.
Sure.
one.
It's your gross revenue less your subconsultants and your reimbursable expenses. So it's the revenue that you get to keep to operate your company.
Okay.
It's the revenue that you will be able to. It's much more important to know the stability of that money because it's money that you get to keep. Yeah. It's not money you're paying out.
Okay. And then I know a lot of times firms can't always answer what that is. I mean, they have a challenge with that sometimes in getting that information.
Well, the challenge is often, like you were saying, from the accounting software. That's often it because it does not, it's not readily set up to track that. So we will see accounting that looks more like we're selling stuff, like it'll be cost of goods sold or what are some other ways? I mean, we've seen it reflected different ways. We just have to go back through the operating expenses to pick up
We'll see
subs.
cost of goods sold, and then we'll occasionally see kind of work in process. And it being treated as a manufacturing or a construction company.
Right.
And so it's net service revenue is very specific to this industry with the amount of consultants, sub-consultants. There's a lot of different groups working on a similar project. I mean, you've got the architects, you've got the engineers, you've got the developers, and so there's a few different groups, and they're all consulting with each other, and so it can get a little bit messy, but we try to work with the accounting software programs every once in a while to get that cleaned up.
Yeah.
Okay. And you speak of, there's a couple of things you brought up there that I think are important for further elaboration. The different accounting programs that people are using, and you guys are in firms all the time and interacting with individuals. Would you say that it just seems to be a patchwork of different programs that are being used out there? There isn't one single entity that's being represented within the financial department of any firm?
I would say the most common. Intuit's really common. That's probably the most common, but I think like the gold standard one in this industry is probably Deltek, a Deltek product like a Jira or Vision, but you're right, Intuit is probably what we see the most often, that's a QuickBooks product, right? Yeah.
Right. Okay.
Yeah.
All right. And so when you go into an office and you see somebody using Intuit, if it doesn't readily create those figures for net service revenue at all.
I can't speak to how they're set up. I'm not sure, but when we see numbers that are from those financial statements, we just have to recast them ourselves. So what they send us,
usually included in direct labor.
Yeah.
So it's you'll have your total income, and then for the financials we see through Intuit, it'll be within direct labor.
Yeah.
Will also be sub-consultants and reimbursables.
Okay.
And so we kind of move that or transfer that above direct labor, and so we've got total income minus the reimbursables and sub-consultants to get gross profit, and then we'll subtract direct labor and operating expenses from there.
Okay. All right. Do you normally kind of take most of that information out of Intuit and put it into a spreadsheet and then work with it from there? Is that the easiest way to do that, to gain that information? Or can it be done in Intuit itself?
I do not know the answer to that, if it can be done.
If we have access to the software, it can be done, but we don't have Intuit. We receive kind of a PDF form for financials, and so we have to transfer that over to Excel and then work on it manually through there. Yeah. And so we don't use Intuit. We'll get it into Excel and then go from there.
As you would with any situation, you would get the information and then generally put it into a spreadsheet and manipulate it from there.
Right.
Okay. That's probably the easiest way to do it. I would imagine, outside of some specific industry specific programs like Deltek that probably have that capability to do that. So okay. Well, There's a lot that goes into this. I mean, who would have thought that accounting is so...
It's a beautiful thing.
It is a beautiful thing. So says the accountant, CPA. So, all right. So let's talk a little bit more about the importance of internal reports and what they include. I know there are two different types of reports. You have those that you share with your organization, and then those that go out to the world. And so, if you had to kind of give us some semblance of an understanding of the importance of internal reports, first of all, and then what are some of the key internal reports that you would share internally?
Yeah, I'm gonna let you take this one just because you are in management.
I'm ready. Yeah, put me in. Yeah. I think the single biggest mistake that firms make is not sharing this information. We work with firms all the time where they have opted not to share any internal financial information, even more than profit on a project. They will not share that internally.
Okay.
And I talked to a woman who's a project manager at a firm that doesn't share any financial information, and she said, well, what am I supposed to be managing? If a successful project is not defined as one that's profitable, what is it?
Right.
So not arming your people with this information really puts you at a disadvantage. Instead of having a bunch of people trying to help achieve the same goal, now everybody's just hoping that they're doing the right thing. Yeah. It's really just about sharing information. Everybody wants to be part of successful projects and successful teams, and there's a lot of reluctance to share information for reasons as human as, well, it'll cause competition and infighting. We want them to take this project even though we know it's not going to be profitable, which happens all the time, right? Like we all take loser projects on because there's a reason. Yeah. Either we love the client or we want to win work with them. Or we just feel like it's something we want our name on. People take projects for reasons that aren't necessarily profit. Right. But when we don't tell people what we expect from them and give them that information in the form of internal reports, everyone just feels like a failure instead of feeling like they're doing something for a reason. It's that why, why am I doing this? And I think that's really the opportunity with sharing that information. It's empowering people across the organization to contribute. And I've loved seeing what I've seen in our company in terms of sharing financial information. Yeah. People at every level of the organizational chart, the first time they get one of our open book management reports, and we'll talk more about that, but the first time they get one, they'll come with these questions that are like really in-depth questions about how our company operates, and I love it because you can see who's really thinking and processing and has that inherent entrepreneurial drive of like, well, how do I make that better? Or why are we only doing this? And I'm like, I don't know, man. I just work here. Yeah. But it's great. It's great to give people the opportunity to step up to that. To me, that's my pitch for sharing numbers internally.
Yeah. Well, good. And certainly we'll spend a little bit more time talking about that. But I think the internal reports are, unfortunately, a lot of firms don't give them the time and give them the weight that they deserve. And I think if anything, that anybody watching this video can take that away and maybe go back to the drawing board and rethink how they do their internal reporting, because honestly, the more people that you can get involved in the process and to become true stakeholders in the ultimate success of the organization, they'll be able to, they'll be able to really, really grow things. So what about external reporting? What would be included in the external reports, and what kind of reports would do those comprise when sending out to the world of what your firm's doing financially?
I would say, you touched on it earlier, but banks are the number one. I think, to take this a step further, I think every firm should have a line of credit, whether they ever intend to use it or not. They're really cheap to put into place. Interest is cheap. They're secured by your receivables. They cost really almost nothing compared to the sleep you will stop losing after wondering, if we don't get paid, whatever, with our 77-day average collection period. But understanding what your bank's metrics are, what they expect you to measure up to, and having a special report formatted to that audience.
Right.
Also one that just explains kind of how we operate as an industry too. So, I don't want to go too far on this tangent, but, a line of credit is usually secured by receivables. Most banks will discount your receivables if they're over a certain stage. So for most companies, it's 60 to 90 days, 90 to 120 days. In this industry, the average is 70-something. Right. So if you are collecting even slightly slower than average, you could have receivables that are not eligible according to your bank's definition. Right. Now, instead of having that conversation when you actually need to draw on it, if you tell your bank, the average collection period in our industry is 70-something days, we usually collect at this many, we think you should shift the clock to a different date. and having reports that support that, that say here is what our average is, here is what we normally do. I think it changes the risk profile because, as a former banker, that is what we would look at.
Yeah.
Aged receivables are terrifying. It means you're not getting paid. In this industry, it means business as usual. There's nothing inherently alarming.
Right.
But organizing, and there's other ratios too that banks like to track, but just knowing what they are, what your bank is tracking on your company, I think puts you in a more, you're in a more able position to go and have the conversations you need to have when you need to have them.
All right.
And for external reporting, we talked about cash and accrual basis at the beginning of the segment. But for external reporting and valuation purposes, it's really better to use accrual because it gives a better true value of your company and gives those creditors and those banks a better, just a more reflective value of the cash flows and value.
Okay. Now, Jamie, I'm going to ask you to go one step further and put your credit hat on, since you did work in a bank and you had that experience and background. If I'm a design firm owner and I had come to you for a line of credit, and I came armed with, say, data from the financial performance survey from Zweig Group or any financial performance survey that supported that average collection period of 77 days and made my argument for that. How much weight would you have given to that data in your decision-making process?
A significant amount. There's very little that is, there's bank policy, but bank policy isn't the same as like law. Like everything is negotiable with your line of credit. Almost every single aspect of your line of credit is fully negotiable. So if you inform the bank or the other side of the table with what you need and why you need it done differently, most people want to serve their customers just like project managers want to serve their clients as well. They, if we can have more information, we can be better members of your team for whatever it is you need. So I would say that there's definitely a lot of latitude there.
Okay, there you have it, folks. I mean, right there, that's worth the price of admission. Just that little nugget of information.
So we can leave?
Yes. No, not quite. I'm almost done with you guys. But no, seriously though, I think again there are some points here on this training that I think are really important, and depending on what your role is in your organization, that information that Jamie just shared is huge. We all know that a closed mouth doesn't get fed. If you don't ask for something, you'll never get it, first of all. Secondly, she just gave a really great blueprint for how you could potentially make an argument for a stronger line of credit with your particular financial institution, and just some ways to go about that. So certainly take that to heart, and hopefully you can find some insight and encouragement from what Jamie just shared that might even propel you to go back and try to renegotiate your current terms with your bank and your lender. So thank you for that.
Yeah, absolutely. And one more point too on banking that, especially if you're a multi-office firm, I think it's something to look into is Lockbox feature. So you can have all of your checks sent to a single address, which makes a huge difference in a company that might be serving a client out of 5 offices that they have, right? And so instead of the firm sending the checks to different offices, those delays they can be incredible with the money going to the right place. But you can set up with your bank, it's a product where all of your checks can go to a single address. They will deposit them for you. And it saves on average something like 14 days.
Really?
Yes,
wow.
It's a really big, it costs money. It's an investment, but if you're large enough and you have enough cross-office billing, it can really help you get paid faster, get the money in the bank faster. That's the goal. That's what really the summary of this entire course is. Get more money in the bank faster.
That's what it's all about. Let me ask you this question, and just because since you brought that up, and again, a lot of this is just informative for me, and I've heard the Lockbox feature before, but how often do you go into fairly decent sized firms that don't even have this?
I would say very, very few firms have it.
Really?
Very few, yes.
Wow.
I think most people don't realize the time, like the time value of money that they're giving up by, let's say the average is 7 days. Maybe I was wrong on 14. That having 7 days of your firm's average revenue, having that in the bank to spend faster, what that can really do for your company. I don't think most people quantify their revenue like that.
I think it's important.
It is. It really is.
Yeah. Even in our project management training, when we go in and we tell people, we talk about the average collection period and how much does each day represent for a company. It's easy. I mean, it's easy to figure out those numbers and then figure out, okay, wow, each day it takes X amount of dollars for our company to run.
Right.
So 7 days times whatever that is, and that can be I mean, if you look at a $10 million company, I think that figure is like $27,800 a day. In 7 days, I mean, that's $140,000.
Yes,
So, I
it
mean,
takes all
be,
the liability too of having somebody from your accounting department go to the bank and make the deposit. You know, it takes it just automates the process in a really succinct way.
It makes it easier. Yeah, that's definitely worth the price of admission there. So
man, look at this.
Yeah.
What are you bringing?
Well, that's why I had both of you here. I had to bring the brain trust here for this one. So we hear a lot about open book management. We've kind of bantered about and talked about it. I mean, Mark Zweig has been a huge proponent of open book management for years, since I've gotten involved in this industry back in the 90s. And so there are a lot of benefits that are derived from sharing as much information with your team as possible. Can you just kind of walk through what is included in open book management reports, and why would a company want to change from keeping all the financials close to the vest to sharing a lot of financial information with the whole team? And you guys can share this answer. So if you want to take ladies first, if you want to give your answer, and then we'll let Robert bring up the end.
Sure. So I tell companies to share as few metrics as possible that will help inform the reader. Especially firms that implement open book management, because we ask them that question of why are we keeping it so close to the vest? They didn't think about it that way, so they want to correct that. So instead of keeping it close to the vest, now everybody in the company gets a 60-page report every month. and you know, I mean, I love this stuff, and I close out of the report at page 2 when I get one that long from a company. It's like, okay, just tell me what matters. That's really the point. You don't need to share everything. Share as few things as will move the needle for your company. Identify what those are and share them. In this industry, people have a really bizarre affinity for colors and graphs. Don't just say the number. No. I want it purple, and I want it on a chart.
Right.
I'm actually not teasing at all. I don't know why, but we could reduce a lot of paper if we just said it. But we really like the colorful charts and graphs. So, show people what they need to know to move the needle. And don't just send the numbers. That's another big mistake that companies make. It should start with a cover letter from your CEO summarizing the month, telling people how things went, telling people where we are and why. So we may have had a great month, brought in a lot of money, but did you know we have to renew our seat on this license, and it cost us $80,000 a year? Right. So it looks like we weren't profitable. We actually were. We had a great month, but this is coming up every year. It's those little connections. So instead of people just hearing at the water cooler, whoa, I heard we had a really unprofitable month. Now they know why. It's that connection from the day-to-day to the big picture.
I think it's important. As she said, visuals are always helpful for everyone. We're visual people. We can see whether we're progressing or we need help in some areas or not. But then also, I mean, you don't need to throw someone a 60-page report on something that they don't really understand. And so you've got to be really good about communicating and explaining kind of what your company's focuses are, and being able to communicate those focuses and how you're doing, how you're performing on those metrics, and what your company's strategy is as far as what you're focusing on.
So historical context, so this is how we did last month or year to date or whatever. So not just this month in isolation. Talk about where we were this time last year, this time last quarter, whatever the point of comparison should be. Then also compare it to the goal. So have a goal, and then talk about how we did in comparison to the goal, then talk about how we did in comparison to ourselves. 2 points there to compare yourself to, I think, are really important. I also think that when you implement this, you should always include a definition page. You're going to have new people joining your company all the time. Even if you do an awesome job rolling out open book management, and everybody leaves feeling like they understand it, when you have somebody start the next week, it's the same as nothing happened, right? So just including a definition page helps people, helps people feel comfortable.
Okay, all right. So, well, there you have it. So a cover letter from the CEO or COO possibly, but preferably the CEO, I would think. Some historical context, compare that to the goal, and include a definition page wherever possible, just to kind of explain the language used in the report. And then I guess the other thing is to follow the KISS method of keeping it as simple as possible.
Oh.
Right?
Okay.
Right? That's what I'm hearing you say. Sometimes 60 pages, can be too much. And while accountants would love as much information and data as possible, the average end user that actually gets these reports they just really want the Cliff Note version.
Right.
They want the summary. They want
Yeah.
it broken down to where they just can look over it real quick.
Okay.
Some firms will also include big wins. It's a good time to just, pat people on the back and, if it's over a certain size or whatever the criteria is, just a select few people to call out for new projects or new wins or whatever. I've seen that in some open book management reports, so that was great. So beyond just the profit for the month,
Okay.
Also the liquidity position I think is important too. How are we doing on that? And then some of the metrics that we've been discussing too, some of those.
Okay.
And just being aware of kind of focusing on small victories within different divisions in your company is huge for, aside from the accounting and financial, but just employee morale and improving.
That's a great point. No one should be excluded from this. Overhead, we just kind of ignore them and talk about the project side. Find metrics that matter to your marketing team. Find metrics that your accounting team is really proud of. Include all of those in this. What else do we do that makes us a great company? It's not just us hammering out one project at a time. It takes a lot more. So finding what those metrics can be, that's a really good point, and celebrating those too.
Okay. Which is the perfect segue, Jamie Claire, are the metrics. We really want to kind of highlight and outline some of the metrics that are most important to our audience, to the people that are watching this video on a regular basis. And I know we talked about this before we started shooting, and there are several that come to mind. But why don't we just kind of walk through some of the, and again, just for everybody watching this video, there are a million metrics relative to the financial and accounting space. But we're going to talk about the metrics that I think matter the most in a design firm, for a project manager, for a controller, for a CFO. And so why don't we start with backlog? There's several: backlog, revenue versus expenses. We've got multipliers, utilization, chargeability or utilization rate, and then average collection period are some of the main metrics that we look at to determine how we're doing and how things are going. But do you want to just kind of outline or give us just a little bit on each one of these so that our audience can have a better understanding of, what does that particular metric mean and why is it important? So, and why don't we start with backlog, because I think that's something that a lot of firms should keep track of to know exactly, what's coming down the pike. So, I don't know who wants to.
Yeah, I'll take it. So backlog is pretty important because it gives you an idea of kind of future revenue.
Okay.
And so it's signed contracts for the future that haven't really started yet. And so that just gives you an idea of, really, it's reflective of business development because it's future projects. And I guess that's one way to measure how successful your business development is contracts now and future contracts. And so, like you said, it's really gives you an idea of what's coming up ahead.
Okay.
It's a really important metric too, for a few other reasons. It's actually, of all of the metrics we look at in our valuation survey, the valuation changes the most from internal. So whether you're looking at how much your company is worth for an internal sale, so just buying more stock or whatever it is, versus an external sale. So if you're going to be acquired, the number one metric of all the metrics in our survey that shifts the most in an external sale is not profit, which is what people expect. EBITDA is what people expect. It's actually backlog, which makes sense because that's your repayment source. If we don't have that future work coming in, it's a big fear for any buyer. It should be a big fear for anybody, but it's interesting to me because most people think of EBITDA because we talk about the most, but backlog's actually really important. It's an important one to track too because people are so busy in this industry. And with the project managers listening here, they don't have time to listen to this 1 hour, right? There's so much to do. So, it's taking the time to sit back from your projects and say, I need to close another contract. I need to get something else in the pipeline, even when you don't have time to, because otherwise you won't have something else and somebody else will have, the expression you always use, eat your lunch. They'll have eaten your lunch by the time you're free and able to do it. So making sure that you have a healthy backlog all the time, even when you're too busy, that is the unfortunate job of the project manager. You got to keep closing.
Yeah, keep closing.
And it makes it nicer because when it comes to that year, you don't have to necessarily worry about the revenue portion of your profit. You can focus on the expenses and working on those inefficiencies and efficiencies. And so the revenue's there, and so now it's time to plan for the expenses and how you're gonna improve that part of the equation.
Okay, perfect. So how about revenue versus expenses? we mention that as well.
I mean, I could talk about that for a long time.
I know. Why don't you give us, in a nutshell, just as a metric, understanding the revenue versus expenses?
Yeah, and so I mean, revenue minus expenses, you've got profit, and so that's an important metric just to look on, because that is your bottom line. That's what's going back to, that's what's coming to you as another company. That's what's going to your employees and bonuses and salaries, and well, maybe not salaries, but bonuses and your shareholders. But one important thing with expenses is to really look at a percentage of total expenses that each expense has, and to see how that kind of grows over time, just to really see where you're spending your money. I mean, that's a way you can look at life, and to see interest is really where you're spending your money. And so the same thing goes for your company.
Okay.
And so over time you can really see where your money's being spent and how that is affecting your bottom line.
Okay.
And affecting your client relationships and affecting your employees. And so I think expenses go in very, very well to the value of your company.
Okay. All right. And how about the multiplier, the utilization and all of that? Why don't we talk a little bit about that?
Yeah, absolutely. So multiplier is the markup that you get on your direct labor. So how much are you getting paid by deploying your labor force? That's your multiplier. That's an important metric to track. If you're not charging enough for your projects, it doesn't matter how billable you are, you're not going to be profitable.
Right.
If you're winning every single job, that's actually probably a problem.
Right,
Probably should be charging more, raising that multiplier up.
Exactly.
So charging more for every dollar of direct labor you have to spend. It's what you're able to generate off of that dollar of labor. Utilization or chargeability, it's the same metric. People call them, it's interchangeable as far as I can tell. I always say the opposite one of the company I'm with. I don't know, I'm just lucky. So utilization is the percent of the total labor that's spent on projects.
Okay.
So you can measure it several different ways. In our survey and our data, we have to measure it by dollars. We're limited in our ability to get the hours out of a company, so we measure it on dollars. So how many dollars of direct labor versus dollars of total labor. Now, if you're looking internally, you have the luxury of deciding to do this with hours instead. So you can look at it on a flat base of 40 hours and say, 40 hours a week full time, how much of that is billable, how much of that is not billable. Right. I think it's a mistake to look at it based on number of hours worked rather than on a single base of 40. I think that evens out most companies a lot better. If you look at it with the actual hours worked, somebody could look like they're a lot less billable, because they could be. So let's say you worked 60 hours a week and 35 of them were chargeable. Yeah. You would look a lot less billable than somebody who worked 41 hours a week and 30 of them were chargeable. Okay. Right. But that person who's working 65 hours is probably doing a lot of awesome stuff for the company that we're really excited that they're doing.
Right.
So it's important just to normalize that figure when you're looking at it internally.
Yeah.
This only applies to salaried people. Hourly people, obviously, we can only talk about the hours they're working.
Which is different, and it's so funny, especially from a utilization standpoint. You walk into firms and it's kind of like a badge of honor to say 90% utilization,
right?
And that may or may not be a good thing,
right? Yeah.
I think it's important to understand.
Yes, and that brings me to my favorite metric, because I have a favorite metric.
Oh, okay.
Finally, here we are. It's a revenue factor,
okay.
And it combines your utilization and your multiplier.
Okay.
So it is the net service revenue to your total labor, direct or indirect. You cannot manipulate it by putting a bunch of hours on projects or camping out on projects like you can if you're using just utilization.
Right.
And you also cannot improve this number if you're not charging enough for your projects. You have to both charge more and be efficient in how you do things. So I like it because I think it's more comprehensive, and I think it involves the whole project team. I think the whole team has to work really effectively for you to have a good revenue factor. Yeah. That's why it's really my favorite of the metrics.
So tell me this, just to kind of, because again, I know you go into a lot of firms and get to see a lot of numbers and information. How accurate is that number, the revenue factor number, when you look at a really successful firm? Is it pretty spot on, or can you still find inefficiencies within that?
It is both really spot on, and you can still find inefficiencies.
Okay.
It is really spot on, though, in terms of telling you, and especially if you can look at it by However you break down your company in divisions or teams or market sectors or whatever it is. It lets you see who's paying the best premium for your services, who needs to be charging more.
Right.
If you've got some projects to certain client types that you're not charging enough for, but you have a huge backlog with a client that's paying you a lot more, it can help you make those forward-looking decisions too, I think, really well. I think that is kind of the fallacy of over-focusing on utilization or chargeability, right? That, like you said, if you're 90% billable, what are you doing with that 10%? I always tell people my goal is that you can work like 1 hour a week and make all the money. It is not to work harder, it's to work
smarter
and get paid for it.
Yeah,
it's
absolutely.
both. I mean, and that's why revenue factor makes you really have those conversations.
Okay.
You cannot have a lot of people retired on the job to have a good revenue factor. Everyone's got to be working in the same direction and not being afraid to ask for more fee.
Yeah. Robert, you have anything you want to add to that?
I would love to.
Okay.
So I kind of want to go back into the importance of expenses.
Okay.
But the cool thing about your expenses is it can really show kind of how it can describe your culture, like where you want your culture to be and like where it actually is.
Okay.
And where you spend your money is kind of reflective of what your culture truly is. If you want to be a high growth company, you would think all your expenses, or a big expense line item would be business development. If you want to be known for recruiting just the best of the best, then a lot of it would be in recruitment, training,
And HR.
and HR.
Right.
And so those line items can really explain where your focus really is, and it's important to align that with what you're saying your culture is as a company.
That's really true.
And so managing those as well as managing the relationship between revenues and expenses. So say this year you broke even.
Yeah.
And so you're like, all right, we need to go out and get some more projects, and your revenue's increasing. But if your expenses are increasing the same amount, then you're still at break even, and what improvement has been done.
Right.
And so you've got to manage that relationship between revenues and expenses. Whereas you say your revenue has stayed the same for that next year, and you decrease expenses, then your bottom line has gone up, and you haven't increased any revenue, you just decreased expenses. And so you've got to be aware of that relationship and kind of give equal balance to both revenue and expenses.
Okay. All right. And I wanted to end up this section specifically with two things, and just to kind of relate the two, because I know one that it's talked about but not always. It's a term that's not always used, and then the other one is a term that I learned more about as I got into this industry and the importance of it, and that's WIP. I just love the word WIP, but yeah, exactly. Every time I see it, I think about Devo, really, but that's a whole story. So,
Indiana Jones.
Yeah, exactly. Indiana Jones, right? So, but what can you talk just a little bit about WIP and just the importance of understanding that? Because I think that's something that a lot of firms, when I mention the term when I do trainings, a lot of times people are like, well, we keep track of it, but we didn't really call it that, or that's not what we understand it to be. So
yeah, I guess to give a kind of a basic definition of WIP, work in progress, is kind of a current backlog. Is like it's backlog it's up to us now, and so it's a contract that's been started, but it's not been completed yet. It's kind of in the process, and it's not only in the pipeline, it's to us now, and so but it's not completed.
Yeah.
And so it's projects that are currently active.
And the importance of that being not completed is that, generally that means that we can't bill until it is completed.
Right. So it usually, in most firms, we see it recognized on the balance sheet, unbilled WIP. So it's more pre-AR. So the work has been done, but we have not invoiced it yet.
Right.
So it's that portion of the backlog that should be turning into revenue and AR, at the same point. So all over but the billing is kind of another way to think about it. But most accounting software that's not for the industry doesn't track it. Yeah. And I would say it's probably the number one thing that we see omitted from balance sheets. So when we're valuing a company and we don't have that, you're understating the value. Right. It's an asset, and it's often not tied to a specific liability either. So we'll see it, and then you're just reducing the value of your company if you're not tracking it.
Right.
And so it's essentially AR backlog.
Yeah, that's it. Yeah.
Okay. And in a lot of instances, it's also looked at in terms of the number of days too, I think.
That's how. Yes.
So
yes.
I think the average, according to our most recent financial performance survey, is 17 days of WIP.
Is that right? So it went up this year. It was 14 last year.
Went up by 3 days, so it's 17 days, and this is for 2018. Those of you that are watching it this year, but that is where we're.
That is a very long time. So that is work that is ready to be billed and has not yet been billed. Generally, at most firms.
Yeah,
so it's more than half a month. It means you're billing once a month-ish. Usually, is what that would mean. Anything you can do to get that out the door faster. Get your PMs to get their stuff approved faster. We can go back to the earlier conversation, just rewind this to the part we're talking about the delay value and the days.
Yeah.
This is a great way to speed that up. Bill more frequently.
Right.
If it's ready to bill it.
Bill it, yeah. And that's a good point especially for you project managers out there. You have to get your money, and you need to, a lot of times you're waiting on something, or maybe an issue came up with a project and you're afraid to bill because you don't want to piss off the client. But the reality is that if you have a contract and you've stated deliverables and you have delivered certain things, you need to bill for them, and invoice for them rather, so that you can get paid and you can decrease that number when possible. So I think it's important.
Collections is never fun, but you know it's part of the business, and sometimes you've got to be a pest about it.
Yeah.
But
especially with the average collection period in our industry being 77 days,
Yeah.
that you need to, you need to get paid. You need to take care of that. Otherwise, you can't take care of the rest of the people on your team. You can't. I mean, it just affects everybody in the organization. So, average collection period is important to know it for your organization, and it's important to drive that number down. You don't want to go up with it. You want to go down with that number. So, All right, so in closing, you guys have given us a ton to think about as we develop our accounting and financial skills in this space, and none of you are necessarily going to come up and be, financial geniuses overnight. I mean, this is something that takes time, but I guess, Robert, you would certainly say that, there's a science to this, and that if you just take your time to learn and develop the skill set, that over time you actually can become pretty good.
A lot of it's repetition and just getting as many income statements and balance sheets in front of your eyes, just so that you can really understand each line item and understand how they work. Even if you get one kind of historical income statement that gives you maybe 2010 to 2017, and just go through that year by year and line item by line item, which sounds a little bit tedious, but I promise you'll come out better for it.
Yeah.
It'll give you a lot of kind of information and knowledge about the financial statements.
Okay. All right. Well, Robert and Jamie, thank you so much for sharing so many great tips on expanding your financial accounting knowledge. I mean, there are a lot of project managers out there that appreciate this information. I know I do. And any parting final thoughts, Jamie, Claire, that you have to share before we close out this?
No, this is great. Yeah.
No, you're good. Okay, all right.
No final quote?
No.
Okay. Jamie Claire has always got a good pun, especially when it comes to accounting. But there you have it, folks. We brought in the experts to just kind of share with you some of the things that they see on a regular basis. And so I really, really want to encourage you to take this video, rewind it, watch it again, go use the workbook that we include with this video, so that you can kind of go through and get a better understanding of finances and accounting in the design industry space, and specifically how in most cases it does impact or affect your projects on a project by project basis. And we're going to have so much more. So I really want to thank you for watching this ZLearning episode on how you can be a better financial manager. This is part 1. Stay tuned. We're going to do part 2, which is project financial management from A to Z. And as if we couldn't talk about enough accounting and finance, we're going to do part 3, which is managing cash flow and proactive financial management. So there's a lot more in store for you in this whole area of project management and finances and accounting. And so we look forward to sharing that with you. I want to thank you for watching this ZLearning episode on how you can be a better financial manager, part 1. Stay tuned for parts 2, project financial management from A to Z, and part 3, managing cash flow and proactive financial management. Remember, in order to get continuing education credit, you must follow the instructions in the email that came along with this video, complete a short quiz, and a certificate will be provided to you immediately. If you'd like to share this video with your office in a lunch and learn format, you can do so easily. You only need to purchase additional quizzes for the number of people that watch the video so that they can get their continuing education credit. Check your email when you order this video for additional information. You can always email us here at elearning@zweiggroup.com. You can also email us with any feedback or thoughts too. We love feedback, and we especially love to hear from anyone that was impacted in a positive way by this video training. Stay tuned for our next ZLearning class. Whether you are looking for online continuing education classes in project management, business development, marketing, leadership, or financial management for AEC professionals, ZLearning has got you covered. Zweig Group's ZLearning offers fresh and relevant content that won't put you to sleep. Visit us at zweiggroup.com/ZLearning for more information. Until the next CEU, we'll see you later.